Hey guys, welcome back to another video. Today we'll be covering Chapter 4 of the International Macroeconomics course. I'm working off the second edition by Robert C. Feenstra, and in this chapter, we're kind of following up on what we talked about in Chapter 3 and the monetary approach, and now we're going to talk about the short term. So in the last chapter, we covered purchasing power parity. That was the PPP, the big assumption that over the long term, prices in the goods market, so the price of an apple in Canada versus the United States in the long term must equalize so that the relative price, accounting for the exchange rate, will be the same. Okay, so it'll equal 1, right? But that holds true in the long term. And the study's research has shown that any deviation, if one price changes relative to the other, every year, that deviation is reduced by 15%. So it will take about 8 years for prices to equalize, assuming no further changes, right? So this is a great long-term model, the monetary approach, but in the short term, we need something. And so Chapter 4 talks about the asset approach, which is the short-term version, okay? The monetary approach developed in the previous chapter fails to account for the short run when PPP fails to account for deviations. This failure prompted economists to develop an alternative theory to explain exchange rates in the short run. This is called the asset approach to exchange rates. Now, the asset approach is based on the idea that currencies are assets. The price of the asset in this case is the spot exchange rate. The approach complements the monetary approach and helps us build a complete model, which we'll use later on. So the asset approach is the short run. So it's about a month to 1 year, and it assumes that prices are fixed. That's the big assumption. Whereas in the long run, the monetary approach accounts for that purchasing power parity in PPP, and it assumes that prices are flexible, so they will adjust in order for prices of each good to equalize across markets. But that's not true in the short term. Remember, prices are fixed in the short term, and that's what the asset approach will talk about, right? So the foreign exchange market is in equilibrium when there is no expected difference in the rates of return on each type of currency investment. This means that the dollar return is equal to the expected dollar rate of return on the foreign investment. Okay, we talked about this in Chapter 2. Now, this is the UIP, the uncovered interest parity formula. And essentially, it states that the dollar rate of return on dollar deposits, you are assumed to be a U.S. investor. So, you're not, if you have U.S. dollars, you don't need to convert them into another currency because you just invest them in this dollar deposit. So really, the rate of return domestically is the dollar deposit interest rate. Now, if you were to invest in the foreign market in a foreign euro deposit, well, you have the euro deposit interest rate, but you need to convert that currency to euros, right? And then eventually you have to convert those euros back into dollars, right? And that combined process of converting it and then investing in the euro deposit, earning that rate of return, and then converting it back into the dollars is the expected dollar rate of return on euro deposits. So it's that interest rate on euro deposits plus the expected interest rate, the expected exchange rate in the future when you want to convert it back, minus today's exchange rate, all divided by today's exchange rate. So it's essentially the expected change in the exchange rate plus the interest rate on euro deposits equals the expected dollar rate of return on euro deposits. Okay, we talked about this in Chapter 2. If you want to go back and check out that video, I recommend you do to really fully understand this formula. So now we're going to build on this, okay? So looking at the uncovered interest rate parity, there are 3 exogenous variables. Essentially, these are the inputs to the model that will then create an output, right? So there's the nominal interest rate, which is the return we get domestically. There's the nominal interest rate for the foreign deposit, so the rate of return for the euro deposit, and there's the expected exchange rate. So we're assuming that we are calculating and we know what the expected exchange rate will be when we convert those euros back into dollars in the future. And so the output of the model, the unknown variable, is today's exchange rate. So how will the change in today's exchange rate affect this overall situation? That's really what the asset approach will kind of describe. And so this is the FX market diagram. This is a really important diagram that you need to understand because we will use it in probably all chapters post Chapter 6. So this is really important, okay? So essentially what this does is on the y-axis you have your expected return, right? So you have 15%, 10, 5, 0%, right? And then on the x-axis, you have today's dollar-euro spot exchange rate. So it graphs the relationship between the expected return and today's exchange rate. So we talked about how we know the nominal interest rate domestically and the foreign interest rate, and then we know the future expected exchange rate. So these are the known exogenous variables, and so the change will come from the expected the exchange rate today, and so that's illustrated by this. So essentially, for the domestic return, the domestic return is not influenced by the x-axis. It's not influenced by today's exchange rate because you don't need to convert that money. So really, when the domestic return, the interest rate on that dollar deposit is 5%, that 5% is across the board for whatever exchange rate it is because it won't be influenced by that. Whereas for the foreign return, your net return will be influenced by today's exchange rate because if today's exchange rate increases, so there's a depreciation in today's exchange rate, then your net returns will fall. And if there's an appreciation, so the exchange rate falls, then your net return will actually increase relative to before. So we're not assuming any change in the euro interest rate. That euro interest rate that's earned on that deposit, it does not change. What changes and what influences that net return is the change in today's exchange rate. And so that's illustrated by that inverse relationship. Okay, so the FR depends on the spot exchange rate and interest rate on euro deposits, while the domestic return is fixed at the dollar deposit rate. Now you can see the foreign return falls as the spot exchange rate increases. We already talked about this, but why? If the dollar depreciates today, E rises, a euro investment is then a more expensive proposition. So you're losing more of those converted dollars. So you're investing less of the net amount of money into that euro deposit. So your net return will be much lower. And if the expected exchange rate remains unchanged, then fewer euros will be worth fewer future dollars. Now, the equilibrium level of the spot exchange rate is $1.20, right? $1.20 for €1, right? And so it's that intersection point between the domestic returns, DR, and FR. And so it's at the $1.20 level, okay? So really the market in the short term, and this is why it's the asset approach, just in the short term, international traders across investment banks and different trading institutions will buy and sell and eventually equalize the exchange rate in order for foreign returns to equal domestic returns. And so this is an adjustment process. But how does this adjustment process work? Well, suppose that we find ourselves at point number 2. So at this point, the exchange rate has appreciated in value, so E falls, and so you can convert your dollars into more euros, therefore invest into that euro deposit and earn more money than if you were just to simply invest in the domestic return. Therefore, your foreign returns would exceed your domestic returns. So it's much more favorable to convert those dollars into euros and invest in the foreign market. In this scenario, traders would want to sell dollars and buy euros, really to take advantage of that. Like if people see that a better investment opportunity exists in the European market, then people will go there because you're going to get more money, right? So traders would convert their dollars into euros and invest in that euro deposit. What that does is, they're selling their dollars and they're buying euros. So that selling pressure will push down the value of the US dollar, whereas it will bid up the value of the euro. And what that does is then, therefore, it increases the exchange rate because now with the weaker dollar, it costs you more dollars to buy €1. So the dollar becomes weaker and therefore the dollar depreciates. And so eventually it kind of pushes down and pushes you all across the x-axis, pushes you towards the right, eventually equalizing at point 1 where people say, okay, the same investment, I'm indifferent between foreign investment and domestic investment. On the other hand, or if we're at point 3 over here, so now the dollar is very, very weak, and so it costs a lot of dollars to exchange for €1, then there's no incentive to really invest in the foreign market. We just invest in the domestic market. And actually, it's much more favorable for us to invest in the domestic market. So traders would want to buy dollars in order to invest in the domestic market. And what that will do is it will bid up the strength of the dollar. And the dollar will increase, and therefore the exchange rate will fall and appreciate. And therefore, it will equalize back until it gets to point 1. And so that's the adjustment process in the FX market. Now consider the exogenous variables. So we talked about how we know the nominal interest rate for domestic deposits, we know the nominal interest rate for foreign deposits, and we know the expected future exchange rate. So those are the exogenous variables that we know about this model, and the output is the exchange rate. So what if these variables, these exogenous variables, the ones that we know, change? Well, if there's a change in the domestic interest rate, it's probably the easiest change to illustrate on the FX diagram, because essentially it's not related to the x-axis. So it's just a horizontal line. So if the domestic return increases from 5% to say 7%, well then the line shifts up. If the domestic return falls, the line shifts down. So that's relatively easy to understand. If there's a change in the foreign interest rate, so say for example, the rate of return on that euro deposit falls to 1%, okay? So it now pays a lower interest rate. Well, then the foreign return curve shifts down. So if the foreign return on that foreign deposit increases, the FR curve shifts up. If it decreases, it shifts down. And we can actually explain that a little bit more. So if there's a decrease in the foreign interest rate, and that shifts the FR curve down, making dollar deposits more attractive, right? Now, at that point, if this shifts down, the market is equalized at 0.7, not 0.1 over here, right? So there will be selling pressure. So there'll be buying pressure for domestic returns because the DR will exceed FR. So people will be buying dollars and therefore lowering the E. Therefore, there will be a real appreciation, and the market will now equalize at 0.7. So when there is a decrease in foreign interest rates, the FR curve will shift down, and the new equilibrium exchange rate will be at a lower level. Therefore, there will be an equilibrium appreciation, a real appreciation that will not change over the long term. Okay, and then probably the most confusing one is the change in the expected future exchange rate. So now it's that E with the upper E. So in this case, what it's saying is, okay, so our today's exchange rate doesn't change, our domestic return doesn't change, our foreign return doesn't change, but the added conversion process changes. So a decrease in the expected exchange rate, what that means is essentially the dollar will strengthen in the future. Therefore, the foreign returns, the proposition for foreign returns were lower. So when the expected future exchange rate falls, domestic returns become more favorable because the dollar strengthens. Therefore, the foreign return lowers. If the expected exchange rate increases, therefore the dollar is expected to weaken in the future, and therefore the foreign return curve will increase because the investment proposition for foreign returns is more attractive. So think of it as that way. Okay, so the domestic return curve, very simple to understand. The foreign return, if the interest rate on foreign deposits falls, FR curve falls. If it increases, it increases. For the expected exchange rate, if the expected exchange rate increases, that means that the dollar is expected to weaken. Therefore, what will happen? Well, the foreign return curve will be pushed up because it's more attractive to invest in foreign returns. If the dollar strengthens, then the domestic returns are much more, and therefore a decrease in the expected exchange rate will lower the foreign return curve. So now, recall that the previous chapter, we talked about the money market. And when considering the asset approach, determining what the domestic interest rate is comes from the money market. So it's that intersection between the money demand and the money supply lines. And so the key assumptions in the long term, and when we were talking about the monetary approach, is that the price level is fully flexible and adjusts to bring the money market in equilibrium. The nominal interest rate equals the world real interest rate plus domestic inflation. Those are the key assumptions in the long run. And we talked about how if we were to increase the money supply by 10%, then the price level would instantly change by 10% to adjust for real money demand. But in the short term, price levels are sticky. So the nominal interest rate is fully flexible, and instead of the adjustment process coming from the price level, the adjustment process will come through the nominal interest rate. Okay. So just once again to talk about why our price is sticky, because in the short term, this assumption is called nominal rigid. Okay, so let's start at one. Okay, sorry. Let me just get a drink of water because I'm really thirsty. So essentially, why our price is sticky? Well, nominal wages may be sticky because of the long-term labor contracts. There are menu costs that exist for those businesses, and if those businesses change prices on a day-to-day basis, they scare off consumers. So it just doesn't make sense for prices to change on a day-to-day basis. That's why prices are sticky in the short term. And you'll probably see, businesses kind of change their prices every 6-7 months, because if you were to go in and buy a cup of coffee and it costs you $2 a day, and then tomorrow it costs you $2.50, you'd be like, what the hell? I should have bought more yesterday, right? And that kind of will scare off consumers. Right? So why are interest rates flexible? Well, the long run assumption is that the world real interest rate equals the interest rate equals the world real interest rate plus domestic inflation, right? So that's the interest rate, and that's due to PPP. Now, PPP does not hold true in the short term, right? So interest rates are very flexible. So it doesn't have to equal in the short term. The world interest rate does not have to equal world interest rate plus domestic inflation equals the domestic nominal interest rate, because PPP does not hold true in the short term. Instead, interest rates can adjust and they're very flexible in the short term. Okay. So, to recap, in the long run, prices adjust to clear the money market and bring money demand and supply into line. In the short term, prices are fixed, right? So the nominal interest rates are free to adjust. So the adjustment comes through the nominal interest rate instead of the price level. And so here is the example. This is the algebraic expression of the short run real money demand. So we have our money supply in the US divided by the price level in the US, and that little hat over there represents that it's fixed. So it's the fixed price level. And that equals the L constant with the inverse relationship between the interest rate times the real US income. Okay? And so the L, so whenever this equation does not equal, the adjustment comes through the I. In the long term, the adjustment process would come through P. Okay? So now let's look at a more graphical illustration of the money market. And we talked about this in the previous video, but in this video, I just want to show you how in the short term this adjustment process occurs. So suppose the market was at point 2. And so at this point, you'll see that money demand, so this little line, you could say that this little line over here is less than money supply. Money supply is at this level, and money demand is to the left of it. So you have money demand is less than money supply. What happens here? Well, the adjustment process pushes the nominal interest rate until the market is at 0.1. So what will happen is that the nominal interest rate will fall until it equalizes to 0.1. And as the nominal interest rate falls, money demand increases. Remember, because it's an inverse relationship between the two. And this adjustment process occurs in the short term. That's why the nominal interest rate will vary. It will increase up and down depending on where money demand is relative to money supply. In the long term, once again, the interest rate will be the same. But what will happen is the money supply will adjust because the P variable over here will shift. It will either increase or decrease in order to make sure that real money supply equals real money demand. Okay? So why is this? So why does this adjustment process work? Well, there is less demand than supply. So the banks lower rates in order to employ the capital sitting around. Let me give you an example. So say, for example, you are a bank, okay? And so we start off at equilibrium, and all of a sudden, money demand falls, right? And so, you're charging interest rates of 5%. And as money demand falls, you have this, people don't want to use the money. They don't want to borrow the money that you offer them, right? So what do? You have to lower those interest rates in order for people to be incentivized to want to borrow that money, right? Because you as a bank, you are profitable when you are lending out that money. If money demand falls and money supply stays the same, well, then you need to incentivize those people to use the money to take out more loans. So you lower the cost of that loan, and people take out more loans. Right? On the other hand, if we're at 0.3 where, money demand is higher, so it's at this level versus money supply, well, then there's more demand. So go back to that example of you being the bank, right? And you're offering credit. If a lot of people are taking out loans and you're like, oh my God, I'm almost going to run out of money. I don't have any more money to lend. You need to raise those rates so that you can take advantage of this increased demand and become more profitable, because as you raise your rates, you become more profitable as a bank. But in that sense, all of a sudden, the nominal interest rate increases when money demand exceeds money supply. So whenever you're looking at this adjustment process, think of it as a bank. You are the bank, and when money demand is less than money supply, you want to lower rates in order to incentivize people to increase money demand. And if money demand exceeds money supply, then you want to increase rates in order to kind of reduce the amount of money demanded. Okay? So let's look at more short-term changes in the money market. So once again, the money market is influenced really the L constant in the real money demand formula stays, is that inverse relationship, and we won't talk about it. So the exogenous variables are really the money supply and real income, right? And so as these two exogenous variable changes, the output, the endogenous variable of the nominal interest rate, the equilibrium nominal interest rate changes. Okay, and so let's look at some example. So say, for example, the money supply changes. A money supply change is the most easy thing to represent in the money market, because really money supply is just a vertical line. It's not influenced by the nominal interest rate because the central bank sets it. So if the central bank decides to increase money supply, it's a rightward shift. If they decide to decrease it, it's a leftward shift. So with money demand remaining unchanged, if money supply increases, it shifts to the right, and therefore the equilibrium interest rate falls. So all else equal, an increase in a country's money supply will lower the country's nominal interest rate. A decrease in a country's money supply will increase the country's nominal interest rate. And so if it's an increase, it will shift rightwards, and therefore the nominal interest rate will increase. Now, if it's a change in real income, real income is represented by the money demand line, right? And so if real income increases, this money demand, this little curve over here, shifts to the right. If real income decreases, it shifts to the left. So that's the easiest way to explain it. And as you can see, a rightward shift, what will do is it will result in a higher increase in the equilibrium interest rate. And that makes sense. Go back to that bank example. If you are a bank and you have a certain amount of money, if real money demand increases, people are going to want to borrow more and more money. So you raise the cost of lending in order to get a little bit more profit, and at the same time reduce the amount of demand so you don't completely run out of money. And so that's why there's that adjustment. Whereas if money demand falls, all of a sudden, people don't want to take out loans anymore. You got to lower the cost of that loan in order to incentivize people to take out that loan. And therefore, there's that downward shift in the equilibrium interest rate when money demand falls. So now let's consider an example. So consider the following example. The home country central bank switches to an expansionary monetary policy and allows the money supply to grow at a rate of 5%. So this is simply represented by that rightward shift in the money supply. So when in the short term, and this is this chapter what we're talking about, because prices are fixed, what will happen is the interest rate needs to adjust. So that rightward shift in the MS curve will lower the nominal interest rate, the equilibrium interest rate, and that's what will happen. Whereas in the long term, because prices are fully flexible, an increase in the MS it will be matched by an increase in the price level. So really, this line will not shift in the long term, because whatever change happens to the top variable will be represented by the same percentage change in the bottom variable. So if M, the top, the money supply, the nominal money supply increases by 5%, the Fisher effect equals, so inflation will also increase by 5%, and so the price level will increase by 5%. So nothing will change, okay? So now the asset approach in the short term, we can now actually combine the FX market with the money market diagrams to really look at a more fuller example. And so really you start on the left-hand side. So you start whatever change you're going to be analyzing, look at it from the home money market and see how it affects the Forex market. And really the relationship between the two is that equilibrium nominal interest rate. Whatever that nominal interest rate is the domestic return of that economy. So if nominal rates increase, then the domestic returns shift up. If nominal rates decrease, domestic returns shift down. Okay, relatively easy to understand. Now, there are two important considerations when looking at the asset approach in this full diagram. One, capital mobility is crucial. We assume that the FX market is subject to arbitrage forces and that UIP will hold. In addition, there are no capital controls limiting the flow of capital between markets. So we're assuming that, if there's a 0.2 or a 0.3, the equalization process will probably take a day or two, because, capital will move freely, and there are, thousands and thousands of traders. It's a global financial market. We'll realize this and we'll take advantage of this arbitrage opportunity. In addition, putting the model at work, you start in the home market, as I said, and then determine the nominal interest rate, the domestic return, and then consider how that's reflected in the FX market. So the most straightforward shocks to analyze are temporary shocks, because with permanent shocks, what happens is, that expected inflation rate changes. But with temporary shocks, really, it's just a little shift. It's a shift in the lines of the curve, so it's much more easy to understand. And so we'll look at two examples: a temporary shock to the home money supply and a temporary shock to the foreign money supply. So consider an example where the MS, the domestic MS, increases. So there's a rightward shift in the MS curve. This results in a lower nominal interest rate in the short term because prices can adjust, so the nominal interest rate adjusts. So there's a short run drop in the nominal interest rate. Therefore, domestic returns fall. And so as the domestic returns fall, the DR curve shifts down, and the new equilibrium exchange rate in the short term is at 0.2. So the equilibrium exchange rate increases, and there is a real depreciation. Okay, now if there's a temporary shock in the foreign money supply, assume that the foreign money supply increases. So this rightward shift, imagine that this was the foreign curve, right? So this was for the foreign market. Well, for the foreign market, the foreign interest rate on those euro deposits would have to fall. So foreign interest rates would have to fall. So when foreign interest rates fall, the foreign return curve falls, and we talked about that earlier. And so now the equilibrium exchange rate, the new one at 0.2, is actually lower. So the lower E represents a real appreciation. Okay? Now, a quick overview before we go into longer term shocks. So for the asset approach, when you're looking at that price, the price formula working off the quantity theory, so the price level is fixed. So really the change, if there are any changes in the money supply or the real income, the adjustment process will come from the L constant, dependent upon, the nominal interest rate. But if we go to the P level in the monetary approach, the price is fully flexible. So whatever happens to the money supply or the real income, the adjustment and for equalization will come from the price level. Okay, and then in addition, when you're looking at the interest rate over here, you'll see that again, for the asset approach, you have your dollar deposit, so the dollar return domestically and the dollar return in foreign markets. The dollar return in the foreign markets is dependent upon the UIP formula, the uncovered interest parity formula. Okay, and so talking about this, temporary shocks are seen, as seen in the previous section, represent only one kind of monetary policy change, one that does not affect the long-run nominal anchor. So when you're talking about temporary shocks, you're not going to be looking at the monetary approach. You're only going to be looking at the asset approach. Whereas if you're looking at permanent shocks, there will be you have to represent it in both the monetary and asset approach. Okay? So let's look at permanent shocks. So what about a permanent shock to home and MS? So really what you do is you start in the long run and you work your way backwards, right? An increase in the money growth rate, and we talked about this in the previous chapter. If an increase in the money supply, there will be a proportional increase in the price level and in the exchange rate. In the long run, an increase in M results in an adjustment in P to ensure that the real money supply remains the same. So if M increases, if the numerator increases, the denominator also has to increase. So M divided by P, so the real money supply in period 1, will equal the real money supply in period 2, regardless if the money supply increases. Because if M increases, then P also has to increase as well. So in the FX market, however, some changes do occur. So even though the MS line will stay the same in the money market, in the FX market, the expected future exchange rate will also increase, which results in foreign returns increasing. Thus, the FR curve shifts up. So let's make sense of this. So the MS curve stays the same. So the MS curve stays the same. The MD curves also stays the same. But because of that increase, referring back to that Fisher equation, if the price level increases, the inflation rate also has to increase, and therefore the expected exchange rate will increase as well. The dollar is expected to be weaker in the future. That weaker dollar, therefore a higher future expected exchange rate, then makes foreign returns more attractive, because you'll get a higher return as the dollar weakens in the future if you invest in the foreign market. Therefore, the FR curve shifts up. And in the short term, we already talked about this, the price is fixed, so an increase in the MS will result in a lower nominal I. This means that the domestic returns falls, which increases E, and the home currency sees a depreciation. So we've already talked about this, right? So an increase in the MS curve, in the short term, the nominal interest rate will adjust, right? So the MS curve will shift to the MS2 over here in the short term. In the long term, it'll stay at MS1. But in the short term, it will shift over to the right, and therefore the equilibrium interest rate falls and domestic returns fall in the short term. Okay? That's quite important. In addition, now that you're accounting for this, so and we'll actually follow these steps. So a permanent rise in the U.S. money supply lowers the nominal interest rate in the short term. The domestic return falls. At the same time, the foreign return rises because when you're combining both the asset approach and the monetary approach, you're merging the two theories, and you understand that in the long term, prices will adjust the money supply, and so the money supply will move back to this level, but there is a future expected depreciation in the dollar. The dollar is expected to be weaker. So what happens is that even in the short run, domestic returns fall and foreign returns actually increase as well, right? And so there's a two move approach in the foreign market, and this is a double whammy. It's like an overshooting, and we'll actually talk about it later. But essentially, what this means is that investors expect domestic returns to fall in the short term and foreign returns to be more attractive in the long term because of that change in the expected exchange rate. The expected exchange rate doesn't change in the long term; it changes right away. Right, that's expected. It's not right now. So that expected exchange rate will also shift the foreign return curve in the short term. So an interesting observation is that because the short term sees two changes, the domestic returns and the foreign increases, the increase in the E increases past what the long-term result will be. Thus, the permanent shock causes the exchange rate to depreciate more than it would under a temporary shock, and more than it will end up depreciating in the long term, right? And so looking back at this, we'll talk about chart B over here. So there are two moves, right? There's the fall in the domestic returns and there's the increase in the foreign returns. In the long term, really the only change that will happen in the domestic market is that foreign returns will increase because of that change in the future expected exchange rate. But in the short term, there is this initial fall in domestic returns. In the long term, this line will move back up to DR. So really, in the short term, point 2 is the equilibrium equilibrium rate, but in the long term, the equilibrium point will be over here, right? So actually, the long-term equilibrium exchange rate is much lower than what it is right now, and so that's called overshooting. I'm not sure. Yeah, it's right over here. So under the permanent shock, domestic returns go down and foreign returns go up. Traders want to sell the dollar for two reasons, right? For the fall in domestic returns and the increase in foreign returns, right? In the short run, the interest rate and exchange rate effects combine to create a double whammy, also known as overshooting. So really, this new equilibrium point at this level is actually not the long-term solution. The long-term solution is where the domestic returns stay the same in the long term, but there's a new foreign return, the higher foreign return. So the actual equilibrium exchange rate will be in the long term will be at this point over here. So it's much lower than where it is in the short term. And so this is the concept of overshooting. The overshooting result adds yet another argument for the importance of sound long-term nominal anchor. Without it, exchange rates are likely to be more volatile. And this creates a lot of volatility if it does occur in the real market. So under a fixed exchange rate regime, the government becomes an actor in the FX market, buying and selling its own currency to influence the spot rate. So now we move past this asset approach discussion, and now we talk about fixed exchange rates, and this is something that we'll talk about in later chapters as well. So in the following section, we will analyze Denmark's krone, which was fixed to the euro. What you will see is that under a fixed exchange rate, the country faces monetary policy constraints, okay? So now let's talk about the fixed exchange rate. So under a peg, the expected rate of depreciation is 0. So when you're looking at this UIP equation, the UIP equation, so you have your interest rate, the domestic returns of the domestic deposits, and then for foreign returns, you have the foreign deposits plus the expected exchange rate, the expected depreciation in the exchange rate. Under a fixed exchange rate, the exchange rate will remain the same. It won't change, right? Because it's under a peg. So this rate of return will be 0. And really what happens is that your domestic deposits, demand deposits, interest rate will equal the foreign demand interest rate, right? So they will equalize, right? So the implications are stark. With the price level fixed, the interest rate determined by the ECB and output exogenous, no variable is under the control of the Danes, right? So the Danes have no control over the money supply, as arbitrage is the key force. If the central bank were to supply more krone and lower interest rates, they'd be fooled by arbitrage. Danes would want to sell krone's deposits and buy stronger euro deposits, applying downward pressure on the krone. To maintain the peg, whatever krone the Danish central bank had tried to pump into circulation would have to be bought back. So, okay, maybe I rushed through this. So let's look at this once again. So this is the UIP formula we talked about. You have your domestic return, and then you have your foreign return, which is combined with the rate of return of the foreign deposit and the change in the exchange rate. Because the change of the exchange rate under a fixed exchange rate is 0, what happens is that really the UIP formula turns into just the domestic return of your domestic deposit equal to the foreign deposit return. So the interest rate of the euro deposit. And that's it, under a fixed exchange rate. That's what needs to happen. So you have no control over your own interest rate anymore. If you were to increase the money supply and therefore lower the interest rate, it would be below the foreign interest rate, and all of a sudden, the currency would weaken and the peg would break. So for really, when you're in a fixed exchange rate system, what happens is that you need to make sure that your domestic interest rate equals the foreign interest rate that you've pegged to, the country that you've pegged to. So really, you have no more control over your nominal interest rate, which of course influences your price level, your exchange rate, and your money supply. So looking at this form of these variables over here, what happens is, okay, so how your money supply equals the price level times L times Y. Well, your money supply also has to equal the same money supply in the foreign market. So essentially, your interest rate needs to be the same as this. This is actually a little bit confusing. Actually, I won't talk to that anymore because that's just more confusing than anything else. All you have to take away from this is that under a fixed exchange rate system, you have lost control of your nominal interest rate, and seeing that the nominal interest rate is all interconnected with inflation, with the price level, and with money supply, you've lost control of your monetary policy. Okay? So our short run theory still applies. Under a float, the home monetary authorities pick the money supply. In the short run, M determines I, and in turn, via UIP, the level of I determines E. Under a fix, it is reversed. Home authorities pick the fixed level of E. In the short run, E pins down the home's interest rate via UIP, which in turn determines the level of the money supply. So by choosing to fix E, they have lost control of being able to change I and, of course, their money supply. Okay? So now let's consider the long run when PPP is true. With regards to the price level in Denmark, if the exchange rate is pegged, the following occurs. Well, if the exchange rate is pegged, then you have your price level in Denmark equals the exchange rate, the fixed exchange rate, times the euro. So, before we talked about how the relative price is you calculate it by multiplying the exchange rate by the price level and the foreign price level, and then dividing it by the domestic price level. Well, under a fixed exchange rate, the domestic price level will equal the net result between the exchange rate and the foreign price level. Okay. So thus, the long-run theory is under a float, the home current authorities pick the MS. In the long run, the growth rate of M determines the interest rate via the Fisher effect and also the price level, which in turn determines E. So we talked about that in the previous video. But under a fixed, logic is reversed. With home authorities being able to fix that E, this determines P via PPP and also I via UIP, which in turn determines MS. So once again, in the short term and in the long term, they have lost all monetary control over their price level, therefore inflation, their nominal interest rate, and the money supply. Okay, so consider the following policy goals, and this is a concept called the trilemma. So essentially, economists refer to this as really the pros and cons of the two systems. So you can only have two of the following three policies. Under a fixed, you can have your fixed exchange rate, right? But then you lose that monetary autonomy. So if you're fixed, then you have 1 and 3, but international capital mobility is non-existent, right? Under a floating, your fixed exchange rate does not exist, but you don't have your nominal interest rate does not have to equal the foreign interest rate, and you have international capital mobility. So there is a trilemma, right? under a fixed exchange rate, you can pick E, but you can't pick P, you can't pick the nominal interest rate, and you can't pick your MS. Under a floating system, you can't pick your E, so you can't pick the exchange rate because it's dependent upon supply and demand, but you can pick your inflation rate, your interest rate, and your money supply. Alrighty, so it is impossible to pursue all three policy goals. This is known as the trilemma. So 1 and 2 imply not 3, 2 and 3 imply not 1, 3 and 1 imply not 2, right? So 1 and 2, so you have a fixed exchange rate and international capital mobility, imply not 3, so you can't really deviate away from the foreign exchange rate. 1 and 3, if you have a fixed exchange rate and you have this, then therefore you can't have international capital mobility and you have to restrict all capital flows. And 2 and 3, if you don't want to, if you have monetary policy autonomy and international capital mobility, you can't fix your exchange rate. So that's the trilemma. Other than that, that's it for the chapter. Another 40-minute video. Wow, so long. As always, I have provided the link in the video description for you to purchase the textbook. It's by Robert C. Feenstra. Also, if you are interested in studying more about economies, please check out my research on Seeking Alpha, where I publish a lot of economic research on different macroeconomies, and I apply some of these topics that are covered in the course. And as always, if you do support these videos and they have helped you, please do check out more of my videos, like and subscribe to my channel, and please comment below with any supportive messages or any comments that I can improve on. Okay, have a great day, guys.